Live. Thanks everybody for joining us today. This is our actual first episode of Real Estate Real Fast with myself, Aaron Jistel, and I've got Romney Navarro, CEO of Streamline Funding, on with us. Real quick, a little bit about me. So I'm the broker and one of the co-founders of ListingSpark. We're a technology-driven real estate company. We work all over the state of Texas, helping people sell their homes when they're ready to get those sold as quickly, easily as possible, utilizing technology every step of the way, and ultimate goal of trying to help them save a ton of money in the process. I've been a real estate broker for over 17 years. I've been very fortunate over that time to have, this year was officially crossed the 6,000 transaction mark. So that was pretty exciting. And one of my favorite things to do is talk shop about real estate. So feel very fortunate to have Romney on today. Romney, I'm going to pass it over to you. And if you want to give a quick intro about yourself and talk a little bit about what you guys do over at Streamline.
Thanks, man. Well, I appreciate it. I'm honored. I know it's the first one. This is a big deal. So I really, really do appreciate it. So as Aaron mentioned, my name is Romney Navarro. I'm the CEO of a company called Streamline Funding. We're a Texas-based private lending company based out of Austin specifically. We do transact in multiple states, but what we are is what you call a private lender. So what we do is we provide capital for real estate investors that are looking to add value to real estate, be it in a fix and flip, a new build, or some type of bridge where they're adding some value in other ways. We've been at this for 20 years. This is actually our 20th year in business. We started super mom and pop. We joke that the first deal was written out of the back of a Corolla because it was. The second deal wasn't very different. Neither was the third, neither was the fourth. But at some point, we started growing into more of an organization with structure. About a year in, we grew into a little bit larger firm. About 3 years in, we started actually managing money for people and investing that money into these projects. Fast forward, I mentioned we've been in this for 20 years. Fast forward to the recession of 2008, our business model changed. People saw a lot of comfort in this type of investing that we do. And high net worth investors started moving capital towards us because we could make investments in real estate deals for the builders and flippers out there that are trying to create value. So it was at that moment, it was kind of an inflection point in our company where we grew from a small company with about $8 million under management to a company that now has approximately $150 million under management. And all that means is that's how much money I lend, how much money I have to lend. So it's a little bit about who we are and how we got here. Ultimately, though, Aaron and listeners and viewers, I help builders grow. That's what I do. I help builders, be it a home builder, portfolio builder, legacy builder, wealth builder. I help them grow by providing more capital to their projects than they could otherwise get through their traditional sources, which are banks, partners, you name it. We're a private lender. We kind of fit that void between a bank and a partner. We're not as cheap as a bank. And not as stringent. We're not as expensive as a partner, but not as loose. We're kind of somewhere over here. So that's who I am. That's who we are. Excited to talk real estate. Lots to talk about in this market.
Yeah. Well, thanks for that, Romney. And it's funny. I think you and I have known each other now for about 5 or 6 years.
Yep.
A big chunk of our business is investors and builders. So obviously, on every deal that they're doing, they're looking to maximize their profits and make the numbers look good. So our business kind of lends itself pretty well to their business model. And so I think you and I met 5 or 6 years ago. We attend a lot of the same networking events, connecting with investors and builders and things like that. And so that's a big chunk of our business. So we always like to have guests like you on to bring value to what they're doing. And so to kind of roll straight into a couple questions for you. For the average new investor or even the seasoned investor, can you walk through a little bit about what your process is as far as lending hard money and how that differs a little bit from conventional financing?
Sure, man. So listen, I know we have a time window here that we need to keep. So I'll try my hardest to keep it nice and tidy. But this is what I do, so it's real easy to talk about it. For the new investor, if you're a new investor that's watching this, I think this is really tailored to you, what I'm about to say, not only to answer his question directly, but how, get into the brain of a private lender or a hard money lender, as Aaron called us. It's funny, guys like me don't like to be called hard money lenders anymore because we've been so institutionalized over the years.
Right.
And this is why. So we have this philosophy internally. It's a proprietary little thing, but everybody's got their form of it. Your banker does, your hard money lender does, your partner does. Everybody's got their form of sizing a deal up. We have this thing called the 5 C's. And the 5 C's are really all that we look at when we're looking to analyze the deal. It's really interesting. Before I tell you what those are, the 5 C's and the significance of the 5 C's changes year over year, market cycle over market cycle. In an up market, the 5 C's are ranked one way. In a down market, the 5 C's are ranked another way. So the 5 C's, simply put, are collateral, okay, the property that is in question, credentials, the real estate investor's experience, a little bit, a lot of it, or none, credit, maybe one of the lesser ones of the 5 C's, but credit, ability to repay and proven track record.
Sure.
Character, okay, is this person have a background that suggests that there's something that we don't want to necessarily transact with? White collar crime, for instance, it's hard to lend money to somebody who's been convicted of stealing money.
Yeah.
And of course, I'm drawing a blank: cash, character, credit, credentials, and I said it first. Cash. That was the first one. So cash. Cash is a very important one. In today's day and age, it's actually become number 3. I don't know when this is going to be released, but the market is in a state of change at the moment. Collateral is the very first thing that we place weight on. It's either a good deal or a bad deal, just on its face, real estate only. Second thing that we're looking at, and this is going to be a good segue, hopefully, to some other conversation, is in terms of order of priority, is credentials. So you ask, what does a lender look for? Or what should a new real estate investor look for? I would say they should look for that. What experience requirements are you looking for? In today's economy, or in today's day and age of shifting, if you will, the big institutional capital, it's basically a flight towards what they call quality, and they associate quality with experience. So there's a couple of things happening here. The new investors are now starting to figure out, how do I transact if these big lenders aren't looking at me? I'll address that in just a moment. So we've got, of course, the collateral. Is it a good deal? Credentials. Is it the person qualified? Have they done this? Do they have a proven track record? And then cash. And all that means is, do they have enough money to float this thing? Right. So we're looking at those things. Notice I didn't even talk about credit, didn't even talk about character. I don't care what a credit score is, really. I don't care what a background is. I do, but those are so minimal. They move the needle that much. The collateral moves the needle a lot. Experience or credentials moves the needle a lot, and cash does. So now new investors are left how do I transact if you care about character? I don't know. I don't know either. No, there's a super market opportunity, guys. Just 6 months ago, the word on the street, everybody was talking about this, is if you find a deal, there is money for it.
Right.
I mean, you remember that. It's there's, right now the deal is king. Back then, deals are a lot more plentiful right now. Not necessarily, 2012, 13, 14 plentiful, but they're a lot more plentiful because that peak, where everybody's buying over market, those days are now behind us.
Right. Or
at least mostly behind us, right? There's still a percentage that will. As a result, there's going to be opportunities for these guys. And what I'm trying to train my guys on right now is, as you enter this space in kind of a volatile time, it's the ideal time to take on a partner. Okay. And a partner could really complement a lender. So if there's a deal that needs $100,000, and where we're sitting in our backyards, those deals don't exist anymore.
Right.
But if there's a deal that's worth $100,000, I may say, look, I'll give you $85,000 so you can do what you need to do, and bring on a partner to bring $15,000. That's a real structure that can make a lot of money. And it's a real opportunity to beef up the resume, to beef up your credentials, and frankly, transact in a market that's, a little uncertain about transacting.
Sure. One of the cool things that we've been able to watch over the years is, we started working with a lot of our investor clients, maybe, 5, 6, 7 years ago. And they started out, they went to a networking event. They maybe signed up for a seminar to get started in flipping. We had the benefit of working with them on their first deal, kind of watched them start to grow as an investor. And what's been amazing is several of them are now building a lot of these ultra modern new construction AB units around town. And I think partnerships are a massive part of that, because obviously it's a big transition. You mentioned you're doing a lot of lending on new construction now. And so it's a big transition to move from flipping some houses to building new construction, especially in the city of Austin, where permitting in and of itself is a huge feat to overcome. And so we found that a lot of these investors that are able to find a good strategic partner might even help get them in the door with your company, somebody that has a proven track record with you already, if they can partner up with somebody else, maybe on their first project together. Do you find that might help move a deal across the line for somebody that's trying to make the jump from just flipping to building?
Yeah, same exact rule applies. I would say if this was like a play call, I'd run the same play and just run it over and over and over again until that experience is now underneath your belt, and it's yours. It's the only way to get a deal to qualify today.
Right.
The way that the capital markets that we all kind of live in work it's really fascinating, actually. And I'm sorry to go off track here, but just to kind of state make it a little bit more understandable. Private lenders, I mentioned I have about $200 million under management. Not all of that is loans, about 160 something is loans, and the rest is other things. But I have about 200 million under management, about $160 is this thing that we're talking about.
Right.
We can kind of make whatever rule we want with it. Right now, we want to pick winners, right? And winners are a lot of different things. Winners are people with, strong backgrounds, strong cash, strong credentials. We can make an exception and say, look, this person's got all of the tools, but maybe they've not done this. However, the degree of difficulty on a fix and flip is maybe here, whereas the degree of difficulty on a new construction is here. That's the equivalent to the amount of things that could go wrong in this project.
Right.
So when we get somebody, a new builder, come to us, that's a very difficult deal to structure. The only way to structure it in this changing market is with a partner. Good news is, we've identified that, right? It's like these guys need a co-signer, for a lack of a better term.
Sure.
Really what they need is a partner, like an operator, somebody that could kind of take them under their wings and say, look, this is how I do it. This is how you do it. And then learn from me. And then the next one, you become the apprentice, and then so on. I have identified a handful of those people that are willing to partner with the newer investors. Those newer investors, will be kind of underwritten, if you will, by those partners. But there's opportunity galore, if you will, inside of the equity space, specifically in real estate. Partners are equity. So yes, absolutely. The concept of partnership right now to kind of grow from one discipline to another, it's kind of everything.
Yeah. Totally agree. Well, I gave you a list of questions before we started. I'm gonna throw you some curveballs, because now that we're already talking, I feel like those are not going to be nearly as interesting as some of the other topics we could talk about. So you touched a little bit about that we're on a changing market, and we're live right now. So this is very relevant.
Ooh.
So with that being said, we have definitely felt the change, right? So compared to 6 months ago, where there was a huge margin for error, whether that was pricing, finish out, you name it, you could sell any house, especially in the city of Austin, but also in DFW, Houston, San Antonio. There was a lot of margin for error on things like mistakes on pricing. If you priced it too low, well, the 20 offers you got would help bring that up. Not quite as easy anymore. We're starting to see more and more. I saw a stat not too long ago that in a single day, there were over 60,000 price drops on homes across the major markets in the U.S. And we've certainly seen that already in Texas. So people are not able to get away with what they were before. So what's some advice that you can give to an investor or a builder that's got a project that's about to be ready to hit the market? What can they do to kind of set them up for success when they're getting everything done and ready to go on the market in a changing market?
Man, you said you're going to throw me a curveball. That is a curveball. I thought you were going somewhere else. So I was like, I'm going to answer this question easily. And then I sat and got nice and comfortable. I was like, oh crap.
Yeah, not an easy one.
No, man, that's a great question. So listen, I was just at a large real estate investment conference down in Tampa, Florida. As you know, obviously we're in Austin. We do some transactions down in Florida, a couple other markets like Georgia, Colorado, whatever. And there was It was good. It was a really good conference. The content, the words, the predictions, the foresight was, very prevalent there. People were talking about what's to come. There was some fear, but here's the interesting part. There was a lot more enthusiasm. And I don't think that's what you see when you turn on the news every time. So the question is, what advice do I have to somebody who's about to go on the market? Well, I have to go the data route. I have to go the data route because it works more often than not. And I have a portfolio of a lot of loans. Let's just call it 200 loans for a simple number. So 200 loans, approximately 20 of those loans mature. Payment, final payment is due every month, approximately, maybe a little bit more. Typically, especially in this run-up that we've been in, post-COVID, just, moonshot, we would never even get to maturity. They just pay me off.
Right.
Here recently, I've got about 50% of my maturing loans looking for extensions. So that right there is telling me that the same thing is true. Some properties are sitting on the market a little bit. So that, problem, right? That's the problem. So what's the solution? And I'm certainly no genius. My clients are the ones that, figure their way out of these things. But, I'm hearing from them what they're doing. And what I'm hearing from them is multiple exit strategies. So if I can't sell, it's still real estate. Maybe I'll rent and wait till I could get the price that I want. Even with high inflationary numbers, the interest rates are still lower than inflation. So it's a good investment in the grand scheme of things. So multiple exit strategies being rent or something else. I mean, you either rent or sell. I don't know what else is in between, but some people are messing with like VRBOs. And I would say if you're in a tight market, that might be a good option. But if you're out in the burbs, maybe that's something to reconsider. And then, this is the hard part, Aaron. I don't know exactly there's no staging trick that somebody could do to really win a house right now. There's no finish out situation that doesn't change your budget. I think that's the key point.
Right.
That could sell a house, because I would answer, you have to be better than the house next door. That's the obvious. But if you're arriving at completion, maybe the things that you do is just put a couple final finishes. Some people call it value engineering into the property. And I think that might be a good play. I know some guys have been doing that. For what it's worth, some raw material prices have been going down or have been stabilizing. So there's a little bit more options there. But my big ones are look different than your competition. You have to be better, because now that the playing field has been leveled, it's no longer everybody gets above market. Look better. And or have an alternative exit strategy. And really the concept of just throwing a tenant in there and then bridging it to the other side makes all the sense in the world, because again, you're going to outpace inflation because your interest rates are so low.
Sure. No, I think that's all great advice. We're seeing the exact same thing. I mean, I think unfortunately everywhere you look on social media, doom and gloom gets clicks. Luckily, and a lot of the news is nationwide news. And fortunately for us, all those markets that you talked about, Texas, Florida, Georgia, those are really strong housing markets. Texas in particular, from the grand scheme of things, we're doing pretty good economically, especially here in Austin. So I don't think all the same news hits home the same way it does in other markets. And what we try to do, especially with our investors, but any seller that we're working with, is we're trying to have very real conversations with them. A word that you use that I think is extremely important is data. So people have to get away from their gut feelings. I wrote a blog article not too long ago with some advice for home sellers and investors. And first thing is you got to stop listening to your buddy who sold a house 6 months ago, or because it's just not going to be the same. The market has changed. It's different. A lot of times right now, the first offer you get is the best offer. And this feeling that we've had from what's been going on, this incredible run up for the last 4 to 5 years, to where, if you sat back and waited, a better offer would probably be right around the corner. That's just not quite the case anymore on every deal. And we're seeing a lot of people dragging their feet on a really good offer. And that buyer now has options. So inventory is starting to creep up. Inventory means options for buyers. options for buyers means their motivation starts to go down a little bit and they start to get a little bit pickier and want to negotiate more. And so what we're trying to tell everybody is you may only get one offer, and that offer might be the best one you've got. So you got to be very focused on making sure you're negotiating the best deal. And understanding, I think, having multiple exit strategies, and then understanding sometimes it's better to get in and out of the deal, walk away with a plus, walking out with some profit and being able to move on to the next deal, and kind of understanding the market is shifting and changing a little bit. And just getting a win and getting the deal sold and making a little money is always a good thing. And maybe not trying to get too greedy is what we're seeing.
Yeah. And that's a tough, not necessarily a tough conversation to have. It takes a minute for that to resonate, right? Like it's almost like my mom told me something once and it was probably the best advice, but I did something different, or, it's so hard to hear that when I need to do this because I said I was going to do this. Yep. You made a good point there. Listen to your buddies. If you have newer investors listening to this, then that is the most sage advice you could get here. Don't necessarily listen to your buddies. You might be, somebody that just acts on intuition and is wonderful at it, but this market is different.
Yep.
So your buddy might be telling you the last deal that he did 6 months ago. I could throw anything on the market and sell it 6 months ago. Can't do that today.
100%.
Your buddy might be telling you, might be just encouraging you because it's like, man, it's time to just take a shot. And you know what? In fairness, probably is. But if you're new, you really got to listen to the data. And what does that mean? Maybe have experts interpret the data. Because right here, I've got a data list in front of me. Not everybody's going to understand exactly what that means, and frankly, maybe I don't. But I'm able to interpret something out of it. And I could share that with somebody. So a new investor really should be listening to the expert's interpretation of the data to form their opinion. And that's why I think also the concept of multiple exit strategies. If this doesn't work, then this works. If this doesn't work, then this works.
Right.
That's probably the best line of defense to the changing market. And generally speaking, as we all know, real estate is an appreciating asset. I think the doom and gloom news is also stating this real estate market's not going anywhere. So we're not expecting depreciation per se. We're just expecting the days of the white hot market to, subside and be more real. So the new investors, guys, if you're new, your buddies are good for encouragement. Your buddies are good for a lot of things, but your buddies aren't good necessarily for the data. They may very well be an expert in something, but if they're not the expert in this, don't listen to them. Experienced investors, though, this is going to be a little bit counterculture. Experienced investors have a gut for a reason. They've been around the block. And sometimes they can get away with listening to their gut a little bit more.
Sure.
Because they're feeling the market already. This thing that we're in, the people that are already in it kind of know where the ebbs and the flows are. And like, okay, I'm on this side of it, so this is what I'm going to do. So an experienced investor, I think, is a little bit more, is going to have a higher batting average listening to their gut than a newer investor. This guy bats 100, this guy might bat 700.
For sure. Yeah. It's always fun talking to the crew that's been around from the 08 days as well. Luckily, I was in the real estate business and went through the first kind of correction we had back in 08 and 09. And again, luckily we were pretty insulated here in Austin, but there was a lot to learn from that. So for a lot of the newer investors or the group of up and coming builders or developers that are getting started that really haven't been through a market correction, there's a ton of information you can get from some of the old timers that have been through 1, 2, or even 3 cycles before, because real estate is a cycle. We're just in a really long overdue one for a correction. Normally you look at real estate trends and it's closer to like a 7-8 year mark. And I think we were at 12 years before we really saw a big correction. So, it's good to grow your network. It's good to talk to some people that have been around the block for a while. And so I think you mentioned earlier, finding good partnerships. Partnerships don't always have to be in the deal either. They can just be a partnership of finding ways to share information, finding ways to structure a deal to make it work through consultations and things like that. And so I think your network as an investor is hugely important to your success. And so having somebody like you on their team is obviously great as well, because you've been around the block. Obviously, you've seen probably every type of deal you could possibly do from an investment standpoint. So I'm sure you've got people constantly picking your brain on what they should or shouldn't be doing. And do you find that that's a big part of your success in this business as well, as being able to take everything you've learned and kind of distribute that out to some of your clients and make sure you're helping them make good decisions?
Yeah, man. I have a team of sales guys. I have a team of analysts. I have a team of marketers. I have a team of back office. I have a team, I have a team of kind of everything, except for, I guess, mental coach. I need a mental coach is probably my next thing. I'm kidding. I have one of those too. I tell some of the guys, in particular, the sales guys and the analysts. Analysts are the ones that kind of make a deal work.
Right.
Investor, new or old, calls us and says, "Hey, I have this situation." And the sales guy's like, okay, I could kind of do this. And then the client's like, okay, let's see. So he takes it to the analyst, and the analyst says, how in the hell do we make that work? And now they kind of get the Rubik's Cube,
right,
and they make it work. It's an analogy for they get a deal approved and funded. I tell those guys, there's kind of this old saying, and it might be a little bit tone deaf because of where it comes from, but what makes the best poker player? And it's like, no, I don't know. It's like, well, it's just the person who's seen the most hands.
Yeah.
All right. So, we've seen a few hands. I've got over $1 billion of these loans funded. Not all of my staff has the same background, but they're part of that. But the guys that have seen $700 million close over 10 years, or the guys that have seen $100 million close over 2 years, those guys are pretty, they've seen a few hands.
Yeah.
The guys that have seen, $1 million closed last week, maybe haven't seen haven't.
Yeah.
So the more hands you see, the more expert you become. And absolutely having some expert advisors on your team is important. So I try to think of our organization trending in a direction away from your traditional banker or lender and being more your local expert advisor.
Right.
So, local, I have a deal in Cherrywood. I think borrower client tells us this, and we're like, got it. That actually makes a lot of sense. I just heard of a property that sold. I think we could do that. That's a local. Yeah. Expert is, of course, here's how we get your deal done. And then advisor is, frankly, that might not be a good deal. Or that might be the best deal. Absolutely put it under contract. So an advisor in that regards, ultimately it's the borrower's decision. We will, gracefully decline a deal if we don't think the borrower, my client, is going to make enough profit on it, or if the exit strategy is stable enough. Going back to data, that's happening a little bit more right now.
Sure.
Didn't happen necessarily 7 months ago, but it's happening a little bit more right now. With that said, getting advice from those that have been around the block a little bit, it's going to help. At a lender level, we could tell you we think it's profitable or not. At a real estate level, they could tell you, or we could tell you, this is what the deals are looking like right now. Here's a bunch of them, or here's the one. At the mortgage level, somebody could tell you this is what the price looks like to refinance. There's so many things. Or better yet, this is what your debt service, how much you're going to pay the bank and how much you're going to earn, and this is how much you're going to put in your pocket. All of those, expert tips and just kind of having those advisors in your pocket are important, which leads me kind of my final comment on all of that. I used to always tell more kind of my clients as we would have like presentations and things and just kind of talk them through some, trying to give them some expertise, some value. Every successful investor has dialed in their deals, like how they get their deals and then their dollars, how they get their dollars, and of course their team. And I think in this market right now, by the way, people are wanting to talk a little bit more, and that's not a COVID thing. This is what's happening in this damn market thing.
Yeah.
Having a bench of advisors, call it your personal board of advisors. Most people will be honored to be on it because 1, we like to talk.
Yeah.
2, it's just, there's always opportunity when you join a team. So
sure.
The board of advisors, personal or for business, I think is a great idea right now.
I love it. I mean, I think investors need to treat what they're doing like it's a business, because it is. I mean, frankly, it is.
1,000%.
Here at ListingSpark, we have a board of directors that's part of the company, but we also have a board of advisors that has been around the block, started multiple companies, run them, operated them. They give us great advice. We use that advice on a daily basis, whether it's for our sales team, our operations team, customer success. And in real estate, investors, builders, it's really no different. I mean, you surround yourself with good people; they're going to give you good advice. Whether or not that's friendly advice, whether you give them a little skin in the game, where if they're giving you the right proper guidance, and that's ultimately leading to you being more prosperous. There's a lot of different ways to kind of structure those partnerships, whether they're just a friendly handshake and you're reciprocating that stuff, or it's actually like bringing somebody on to be an advisor for your business. I think that's hugely important. I mean, I think partnerships are so vastly underrated in a lot of different types of businesses. So I think that's a great takeaway. Well, this was fun. I mean, it's hard to believe we're already at 30 minutes, and I want to make sure we save a little bit of time for Q&A. We actually do have a couple questions in the chat. So first question's from John Thomas, said, "Hey, Romney, I'm new to hard money lenders. Curious, what is the ratio of collateral to deal that you're looking for? Also, what is the typical term length for most deals?"
If John was right here, I'd ask him one more question for clarification's sake, but I'm going to try my best to answer it based on what we've been talking about. So ratio of collaterals to deals, I take that to be one of two things. I mentioned the 5 C's: collateral, credit, credentials, character, and cash. Collateral is what we consider to be a pass-fail binary. So approximately 50%, because it's either yes or no.
Got it.
There's not a maybe in collateral. That's the one thing. The other thing that maybe I've heard, John, and I hope I'm able to answer your question. What is maybe my ratio to the value of the collateral? If I do a loan, how much is, say, the property worth? So going back to data and then going forward. Going back to data, currently, my portfolio consists of 67% loan to after repair value. That's my ratio on my entire portfolio. That means I have some at 75%. That means I have some at 60%. 67 is my average. Actually, it might be 68, but close enough. And then there's the other ratio, and that is the loan to cost. So if a property costs you $100,000 to buy, $100,000 to renovate, that's 200 grand. And I were to lend $200,000, that would mean 100% loan to cost. So the other ratio that I look at is loan to cost. I'm currently operating at about 90% loan to cost ratio. The new market, the new frontier, is trending that down just a notch, about 2.5 points on the loan to after repair value and about 2.5 points to loan to cost. The loan to cost is under attack, just so that you know, but that would put my future ratios at 65% loan to ARV. But I want to, if anybody's saying like, oh, that's too low, that doesn't mean I don't do 70 or 75%. So I'm taking my entire portfolio.
Sure.
I will do a 75% deal right back here in Great Hills. I will do one in, Houston Heights. I do 75% deals, but my entire portfolio is probably trending more towards 65% and 87.5%.
Yeah.
Hope that answers it.
He said, perfect. Thanks. So that was good. I think it's really the after repair value is kind of, that's what's a little bit elusive right now. Right. So in a changing market, that's hard, because ultimately right now, even on a flip, let's say you're at a 90-day project, 6 months ago, how much did the value go up over a 3 or 4 month span? It was crazy. Now it's not changing the same way. So coming up with after repair value is tough. So
yeah,
are you guys doing appraisals on your deals that are happening, or is it more of a desktop appraisal inside the office?
I'm getting both. It's kind of, you ever heard the term belt and suspenders?
I have. Yeah.
Okay. So, both keep your pants up, but one might go out and the other might go out. So I have my internal team run values on the properties. I trust my clients' values too, by the way. So if somebody says, hey, I'm going to sell this for 800, I'm going to say, okay, got it. Let me see what you got it. And we'll come up with our value. But we get an appraisal for a myriad of reasons, but that's more the belt and suspenders approach. If the appraiser says 600, we're like, whoa.
Right.
We never miss by that much. I mean, that's ridiculous.
Sure.
But if they do, we have kind of a fallback. The other reason is, we operate with some larger institutions. While my book of business is as big as I've mentioned, between $160 and $200, depending on the investment type.
Right.
When I'm out of cash, I need to do something. So when I'm out of cash, I actually sell a lot of my portfolio to big Wall Street institutions, and they require it. So, in order for me to fund the next $20 million worth of deals, I need to clear up cash inside of this bucket. But I'll tell you one thing, man. This is I go to a conference or I have a conversation with folks like yourself, Aaron, and I always, every once in a while I grab like a little nugget of information that I think is so fascinating, and I share it with a lot of people, and I overshare it, and my wife gets on me. But I do it because it's like, that told me something. That's something that's cool. It's not always good and it's not always bad, but it's information that I think people could find valuable. And one of the things I picked up recently was people are underwriting values. So if you have an ARV, it's worth $200,000 when you complete it. There has been a time where an investor, a real estate investor, says, today's market says it's worth $200,000, but the appreciation is going to put me at 230. Right. Today, in literally in today's market, that's a bad business model.
Absolutely.
We don't know appreciation. We're underwriting to today's value. I've heard of a larger institution. I have no idea where they're at. A larger institution, let's just call them a Wall Street firm, saying that they're underwriting at a 10% discount. So if it's worth 200 today, they're going to see how it goes at 180. And I'm thinking, says a lot of things. It says that the big money's scared, right? It might even just say this particular money is incredibly conservative. Could say that, but it's something for the viewer, the listener, to think about here. It's like you might speak to somebody that's going to tell you, okay, how much do you think the property's worth? $200,000, and then over here they're like, it's actually 180. I've even heard people, reduce that even more. I don't think that's a bad example or a bad business practice. But what I do think is, you have to look at it all. So the way that I'm telling people is like, okay, you're going to underwrite it at a 10% discount. Wonderful. Actual market value, is it profitable? Yes. At this discount, is it at least break even? Yes. Then maybe we move forward. But if you're telling me that you're looking for profitability at this discount, those deals don't exist yet.
Right.
That's not this part of the market. Those deals happen. And by the way, this market isn't the 2008 market where the banks are sitting on an oversupply of foreclosures and they're just willing to give them away. That's not today's market. Guys like me and you have very low interest rates on houses for very many years.
Right.
So the homeowners losing houses will happen, but not at the same clip. So you need to underwrite at today's value, I guess, is when we're looking, I'm speaking to the investors, not to me or you. We need to say, what is it worth today? Let's assume it doesn't get any better. And if that deal works, you're probably in pretty good shape.
Yeah. No, I think that's great advice. I mean, if you've been in real estate for long enough, you've heard the saying, especially in the investment world, you make your money when you buy, not when you sell. For the last 5 years, that really hasn't always been completely true. If we're being honest with ourselves, we've had a lot of investors that didn't have a great buy. You look at, we can run the comps, especially if that deal floated through the MLS and you can see what somebody paid for it. And there was a lot of bailouts from really bad purchases because they did exactly what you talked about. They bought a deal and it ended up being worth 30 or 40K more when they went to sell it than maybe they thought it would be. And it kind of bailed them out. And that also helped people that went over budget, made a bunch of mistakes. And so what I'm really wanting our investors and other clients and other people getting into investing for the first time is, we're about to go through a phase in the real estate market where those bailouts are just not going to happen anymore. And you really have to start getting a lot leaner on the purchasing side of things. You really have to start focusing on deciding whether or not it's the right deal for you or not, and really ultimately when to walk away. And I think that's the hardest part. So I think that's where a good partner comes in and is able to tell them, the optics of this deal don't look as good as you might think they do. And this one, you might either need to go back and renegotiate with the seller or just walk away from the deal because, we're just like I said, we're getting into this phase where the bailouts aren't going to come quite as easy. And I think you're absolutely right. You have to look at today's value, and maybe you'll luck into in 6 months from now, the value's gone up maybe 3 to 5%. It's certainly not going to go up 15 or 20% like it has in the past. So I think that's sage advice that a lot of people are going to have to start really taking more seriously than they did within the last year or so. So,
man, I hate to, I mean, we could talk forever, but I got to tell you, there's this concept like an investor is an entrepreneur. Like you said,
right.
Treat this like a business. So an investor is looking forward just that way,
Yep.
right? And the appraiser is looking backwards.
Exactly.
So there's this weird little point where it's like, no matter what happens out there, there's some version of, to satisfy your obligation, if you will, to the lender, you kind of have to meet in the middle.
Yep.
What happens this way is great, but this guy's only got data from back here.
Yep.
Right. So it's like that. So there's kind of the center point. But all that to say, opportunities are starting to surface now. Those, I would say the carnage in our market has, if not has occurred, is in the process of occurring for those investors that maybe bought for too much.
Yep.
Not necessarily the homeowners. Homeowners are going to be safe because the interest rates are so low. But those investors that bought for too much might have a little bit of they might have to go to option B and C. And option B might be rent. Option C might be partner.
Right.
But there's still realistic options. But the option A, if option A was to flip or sell, they might be, holding the bag for a little while there. That's, again, we're talking about the guys that overpaid. You list for 100, you bought it for 124. Doesn't make sense in any scenario except one that there's no supply. So opportunities coming, I guess, is what I'm getting to.
Yep. Mm-hmm. Yep. Totally agree. Well, we got one more question. Van, thanks for holding on. Hope you're still on. Van wanted to ask, what's your advice for vetting a lender?
Yeah, great question. Van, good question. I remember John Thomas's name earlier because I have a client named John Thomas. I don't have a client named Van yet. But Van, when we talk about the 5 C's, that's not intended to make you comfortable with me. It's just a little bit of information, like kind of reach into my brain. But one of those C's is character. And character is similar to collateral is binary. It's pass fail. Like I said, if my person seeking financing comes to me with, a white collar crime, I just can't do that deal.
Yeah.
You understand the uneasy feeling. Well, I meet all of my clients too. And sometimes you just get that feeling, right? So Van, if you're a rookie investor or a seasoned investor, I think you got to shake a hand and kind of just get that feeling, good or bad. That's not all of it. That is a sliver of it, but that's almost like the icing on the cake. All the other things that kind of build the cake or the sundae or whatever is what you really need to pay attention to. I think right now you need to be wary of brokers. I think there's been a lot of people disguised as lenders over the recent run-up, in particular post-COVID. Post-COVID's created all kinds of opportunities for salespeople. I think you need to be wary of brokers. Brokers are good human beings, but they're not capitalized. You know what I mean? A broker might say, I can get you this, but they can't necessarily go to the person next to them and say, hey, approve this thing. They're now dialing for dollars trying to figure out who can do the deal for you. The reason I'm saying be wary of them or beware of them is they've, similar to many, like in the marketplace, they're kind of the last to take notice that, those days are not necessarily over, but are under attack. Brokers, if you don't have capital, you don't have the ease to do a transaction anymore. You literally need to hand over, Van's application to another person and let the other person do it in today's market. In the upswing, brokers could disguise themselves as a lender, make representations that they're this, that they're that, and then some lender like myself will just fund it with nobody knowing.
Yep.
So be wary of brokers. Look for lenders that have what's called a balance sheet. Balance sheet lenders are very important in this market. Those are the ones that are frankly going to stick around. We stuck around in 2008 because we had a little balance sheet. Now we have a big balance sheet. Balance sheet lenders get to make their own rules and get to service your loan non-balance sheet lenders, if you're a broker, don't have capital, but if you're a non-balance sheet lender and you just sell only to Wall Street, you're kind of tethered to whatever they say. So one thing to look for is that they are a balance sheet lender. Another thing to look for is that, of course, that you have a good feeling for them. And then, of course, ask for clients. And they're going to give you their best clients. I'll give you my best clients. Maybe I need to rethink that and just kind of, do a whole, pull a name out of a hat and call this guy. Some of my clients have had tons of success. Some of my clients have seen failure. But generally speaking, we answer the bell for them. They need this, we give them that. Not all real estate deals work out the same way. But ask for clients, and then specifically ask for clients with your profile. So if you're looking to build 40 houses, ask for somebody that's built 40 houses. If you're looking to flip your first home, ask for somebody that's flipped their first home, something like that. Give you a little example. I have a client, you were talking about, Aaron, you were talking about beginners earlier. And, we used to kind of call it the freshman mentality. And, I realized that may come across as one thing or another. I thought it was a good thing. I thought of it as a positive thing because the freshman mentality is one that nothing can go wrong. Like everything is possible.
Right.
And you need to start there. If you think everything could go wrong, you don't start anywhere.
Right.
But the freshman mentality was kind of introduced to me by a client of mine. I remember he was an engineer at Dell here in Austin, up in Round Rock. And he called, he's like, hey, I want to do my deal. I was like, what do you want to do? He's like, I want to build a house. Like, man, but you're an engineer at Dell. How are you going to do this? Well, he's like, but I'm an engineer. It's like, I know, mind you, Aaron, this is 2014.
Yeah.
And I don't know, man. I think we took a flyer on the guy and said, all right, let's give it a go. Let's see what happens here. Maybe took him a little bit longer than the guy that's done it a bunch, but he got it done. Took him a little bit longer to sell because, he had the freshman mentality. Everything is like, I'm going to beat the market. Not in 2014 necessarily, but he sold it. He made a profit, called me again. We did it again, called me again, did it again. Fast forward 5-6 years, he's building 125 houses in 78721. So, ask for people that look like your situation, see where they've gone. Right. And then I think that'll give you a little bit of intel as to, what.
It's funny you said that. I can't tell you how many very successful investors and builders that we work with now that all started out as engineers. It's funny. They've got a knack for kind of figuring it out.
Those are my favorite, man.
Yeah, no, it's funny you said that because we see that all the time. Well, Van, great question. Appreciate it. I couldn't agree more, Romney. And just to kind of piggyback on your comments about the broker side of things. It's funny when a broker is beholden to other people's money, especially like Wall Street money. The other thing you got to take into consideration is that they get to change the rules whenever they want. And a lot of times they don't send out a memo to everybody that's trying to lend money that they've just tightened up their guidelines or, things have changed. And so a lot of times the brokers of the world, as opposed to somebody like yourself, like you said, that's carrying the balance sheet, they're salespeople, right? They're trying to get the deal done, and they will try to take it as far as they can when things maybe aren't materializing. And in real estate, a lot of times you hit a point of no return where, the deal is just stretched out too long with the seller. They won't give you any more time. And next thing you know, the deal is falling apart because the money just doesn't show up because the person maybe can't deliver on what they said they could. So I think having a reputation with somebody that you have a long-standing, like you said, this guy started out with built one house. Next thing you know, he's building communities together. That's somebody that you're going to be able to watch grow and build and trust over time. And I think having those kind of relationships really helps. So there's something to be said about finding a really good lender, finding a good partnership, and being able to kind of grow your business alongside them. So
we should do a part 2 of this thing, man. I want to
for sure
pull on that thread.
We definitely should. We definitely should. Well, before we wrap up today, because we're at almost an hour, so I appreciate you hanging in there, and I appreciate everybody listening. Why don't you give everybody the quick rundown if they want to get connected with you guys over at Streamline? What's the best way to do it? How do they start and engage in a conversation with y'all?
Sure. I would say the easiest way is email. I have an email. My staff has emails. Navarro, RNAVARRO @streamlinefunding.com is my personal email. I will receive your input, help you with whatever you have. If you want to talk about a deal, then I will bring some of my analysts in it. We can start breaking it down. But I love to talk about this stuff. So I don't mind, jumping on the horn for 15 minutes on something, sometimes even an hour.
Yeah.
But definitely reach me there. I mean, yes, you could reach me through the Instagrams. You could reach me through the LinkedIns. You could call me even if you want. But email is going to be the best way to communicate. And I promise you that if we've got a deal that we think we could help you with, we're going to offer it. If we don't, we won't. But honestly, I said the term earlier, local expert advisor. Those three things, they're in no particular order. So if you just need an advisor, talk to us. We'll give you what we know.
Awesome. All right. Well, everybody, thanks again. We're going to be doing this every week. So if you enjoyed this one, we're going to be sure to have Romney on again for sure. We got plenty. We could probably do 4 or 5 podcasts. We got plenty to talk about in the real estate world. So we'll definitely have Romney on again. We're going to be pushing these out hopefully every Wednesday around 1 o'clock around the same time. So thanks everybody for hanging in there with us. And hopefully we'll see everybody soon. Thanks, Romney.
Thank you.
All right. Man, that was great. We'll hang on just for 1 more minute and let this wrap up. Man, that was awesome.
To talk.
I know. That was great.
What a great time.
And I got your last email. We're long overdue for another lunch. It's on us this time. I think you brought it in last time. It's on us this time. So we'll have to get together. I'm always fascinated to kind of have conversations with other people like yourself to kind of navigate the market and see what you're seeing. We're seeing some changing going on, but I think you hit the nail on the head earlier that it's not nearly as doom and gloom as everybody's trying to make it out to be. The market's still good for the operators out there that are doing their thing. There's still plenty of success to be had. So we got to push out a little positivity in the world still.
Yeah, and I sometimes I struggle being a business person, running a business, and being kind of a source of information for clients and even the people that we're talking to. Somebody thinks that what I'm telling them is going to help them, and sometimes it does.
Right.
And I struggle with it because right now, as a business person, I know there's an opportunity for me and you. Okay, and the opportunity is people are quite literally retreating. In my world, they are.
Right.
The cash is hiding right now.
Sure.
The lenders or the banks are like, hold on, I'm just going to weather this storm. And what they're really saying is I'm battening down the hatches and I'm not going to make any more investments. And to me, it's like, oh, wow.
Yeah.
How many wonderful real estate investors aren't out there that have just been displaced that need a new source of capital.
Yeah.
So I'm really of the mindset at a business level that when others retreat, we advance.
Yeah.
And I don't know how to explain that to my flippers, my builders, my landlords, those guys that we finance, other than, there is in turbulence, there's opportunity.
Totally agree.
It's always been the case. So I hope that they could find their footing and hit it, because somebody, 1, 2, 3, 4, some group of people are going to come out of this thing victorious.
Well, the institutional money is changing right now. So we hit this phase for the last several years. Almost every listing we had an offer from Open Door, OfferPad, Sylvan, BlackRock, any of those things. Oh, I'm getting a note. I need to end the stream. I think it'll leave us on here. Hold on one second.
Okay.
Let me just end the stream.